Hello world. I'm sure everyone has been seeing ads on the internet and all over the city of the apps Robinhood and Webull as trading platforms for investment and trading stocks. This presentation is to inform you of everything you need as a basic understanding in order to trade as a retail trader or investor in the stock market. Before we get into the presentation, let me introduce myself. My name is Somdat Kisun, and this is the Stock Scene NYC. Please take this time to like the video and subscribe to the channel. So let's get started. I'm sure you've all heard of the terms share and stock before. So what exactly are shares and stocks? A share is a slice of a company in which we can invest. Sometimes companies are so large, one individual would not have the resources to invest the capital into making an idea work for a company. As a result, they may require individuals from the public, or they need the assistance of individuals from the public to put forward some amount of capital or to raise capital in order to carry out their business. That is why they would issue a slice of the company to the investor, and that slice is referred to as a share. When these shares can be traded on a public exchange, we usually call the company a stock or the share a stock. Now, during the course of your lifetime, you would have invested in many items we call securities. Securities are items in your life that hold value, and they can be traded in for cash or value over time. Cash itself is a security. So let's look at some of the securities that you might know in your life. For example, real estate and collectibles. Your coin collection, your toy collection, your stamp collection. Someone might be willing to pay for these things to give you money in return. Real estate is a very popular form of security that people invest in. When we're on the stock market or as a retail investor, you'll be exposed to other forms of securities in the form of stocks, bonds, options, ETFs, and REITs. In future videos, I will be going into details on bonds, options, and ETFs and REITs. However, I would like to point out that when you download your app or when you're retail trading, most of what you would encounter are stocks and ETFs. Now, what is a stock? Well, a stock, as I described earlier, is a portion of a company, and it's usually a portion of a single company. An ETF, I should have put index funds or mutual funds here. However, what you need to know is that an ETF or an index fund or a mutual fund is a grouping of many different companies, and that fund can be divided into its own set of shares that you can buy as well on a retail investment app. Now, all of these securities have different levels of liquidity. Cash has 100% liquidity because liquidity itself is the ease of which you can convert an asset to cash. So cash has 100% liquidity. Stocks and ETFs, we can quickly convert them into cash, while other assets such as real estate and collectibles might not be that liquid. That means that they're not very easily converted into cash. Another aspect besides liquidity that we should know is risk. Each one of these securities come with some amount of risk. In a later video, we will go into the details of the different risks that come along with the different securities. For now, a good rule of thumb to know is that when you invest in a single stock, it could be risky because you could lose your money if that single stock goes out of business. That's why in the market we often hear of diversification. Diversification is where you invest in a portfolio of stocks so that your risk should be lower. That is, if one goes out of business, you still have some amount of money, or as one goes up, the other can go down a little bit, or if a few go down, there are others that will go up to compensate for that. A shortcut to diversification is mutual funds or ETFs. So that's another way of managing risk. However, in a future video, we'll discuss the risks in real estate and in REITs and in options. As with any other investment in life, higher risk is usually high reward and low risk is usually low reward. So why invest? That's a great question. The first thing we should know is that if you're losing cash, you're losing money. If you're holding cash, you're losing money. The first reason is because of inflation. Every year, the dollar devalues by about 3%. That means when you take your dollar to the supermarket, you get about 3% less of groceries than you would have gotten. Another way of knowing that you're losing money is that when you put your money in the bank, you're barely getting any interest of it. The interest rates right now is almost zero. Whereas the bank is taking your money and lending it out in the form of loans to other customers and making a profit off of your money. This is why we should invest in stocks. We could make some money off of our money, our cash, if we invest them in stocks or bonds or ETFs or REITs. So the first way we make money is through dividends. Remember earlier when we said that a share of a company is a slice of that company? Well, guess what? If you own a piece of a company, when that company makes a profit, you get a piece of that profit. The company is going to pay you a part of that profit, and that part is called a dividend. And this is basically passive income because you're able to cash out money without losing the shares from the company. If you own 10 shares of a company and you get paid the dividends for 10 shares, you will still own 10 shares and you will get that passive income in the form of dividends. Another way of gaining money from investing in stocks and bonds and REITs and other securities is through capital growth or growth in the price of a stock. If you invest in a fraction of a company and the value of that company increase, the value of the fraction you own will also increase. When you buy a share of stock, that company could increase in value and the price would increase on the stock market. If you were to sell that share, you would be making a profit, and therefore you will have some capital growth. Now that sounds much better than leaving your money in the bank. So that brings us to the last part. Why is now better than any other time to invest in the stock market as a retail investor? Well, let's go over institutional and retail brokerages. So an institutional brokerage is where you go to an investment bank and you pay a broker a fee to conduct your transactions. This broker would take a commission or a fee or both to place a trade for you, and when you're ready to sell that stock, he would charge you a commission and a fee again to sell that stock. These are usually better for large investors with millions of dollars to spend. And the brokerage, the institutional brokerage, usually do research and give advice for the trades to be profitable. However, we've seen in the past that this is not always the case. Many people use institutional brokerages and they still lose money. That brings us to retail brokerages. Thanks to the internet, we have much more information now that everyone can know a little bit about what's happening in companies and how to invest in them. And two, we have investment apps that make it easier for retail investors like myself and you to buy and sell shares. These are also zero commission apps. When retail trading apps first came out, like Scottrade and so on, they charge commissions. Now we have Robinhood, Webull, eToro, Cashapp, and so on that charge zero commissions, and we can do our due diligence and research and invest in these companies. If you're interested in starting to trade, click in the description below, and there are some free stocks waiting there for you. As always, if you agree with me, if there's anything that I said that wasn't correct, please feel free to correct me in the comments. Like, share, and subscribe. If this information is useful to you, please show appreciation by giving it a thumbs up. If it wasn't useful to you, but it might be useful to someone else, please share. Thank you.